Assalamualaikum and salam sejahtera. In this video, our group member will present about the introduction of tax audit framework, types of tax audit, objective, and also year assessment covered. My name is Niazatu Yasmin and I will explain about the introduction of tax audit. As we all know, tax audits are mandatory for individual and entities with turnover exceeding the limits prescribed. Under self-assessment system, tax audit is a primary activity of the Inland Revenue Board of Malaysia, known as RIBM or Lembaga Hasil Dalam Negeri. It is aimed at enhancing voluntary compliance with the tax laws and regulation. A taxpayer can be selected for an audit at any time. However, it does not necessarily mean that a taxpayer who is selected for an audit has committed an offense. For example, a taxpayer who claims a significant amount of business expenses in their tax return might be selected for an audit to verify the accuracy of the claims. This selection does not mean that the taxpayer committed an offense because it is a standard procedure to ensure compliance with tax regulation.
Hi, I'll be presenting about Tax Audit Framework. The Tax Audit Framework by Inland Revenue Board of Malaysia, IRBM or LHDN is a document that outlines how tax audits are conducted in Malaysia. It serves as a guide for both taxpayers and tax officers, ensuring transparency, fairness, and efficiency during the audit process. The Tax Audit Framework aims to first, assist audit officers to carry out their tasks efficiently and effectively, and secondly, assist taxpayers in fulfilling their obligations, which means the framework provides tax auditors with a structured approach to conducting audits, including standardized procedures. The framework outlines clear steps for conducting audits from initiation to conclusion. This ensures consistency across different cases and auditors. Next, guidance on scope and focus. It helps auditors identify areas of high risk such as underreported income, unclaimed deduction, or non-compliance with transfer pricing regulation. It encourages the use of data analysis tools and risk assessment methodologies to prioritize cases that warrant detailed investigation. The framework serves as a guide for taxpayers to understand their responsibilities and the audit process. For example, clarity on tax obligations. It educates taxpayers on their responsibilities such as proper record keeping, timely filing of tax returns, and accurate reporting of income and expenses. It highlights common mistakes and areas of non-compliance to help taxpayers avoid errors. Secondly, transparency in audit procedures. It outlines the audit process, including the taxpayer's roles, rights, and obligations at each stage. The Inland Revenue Board of Malaysia, IRBM or LHDN, has introduced updated tax audit frameworks for 2024. These frameworks guide the procedures for tax audits and investigation, aiming to ensure compliance and transparency in tax administration. The key features of the frameworks included scope, where it covers corporate taxpayers, small businesses, individuals, and multinational enterprises. Then, the audit process. It emphasizes transparency, fair treatment, and efficient handling of audits. Next, the documentation. It requires taxpayers to maintain at least accurate records for 7 years as per Malaysian tax laws. The updated tax audit framework immediately takes effect on 2024. It provides detailed procedures for conducting tax audit across various industries. It focuses on educating taxpayers about their responsibilities and ensuring compliance with the Income Tax Act 1967. The tax audit framework acts as a bridge between the IRBM and taxpayers, fostering a collaborative approach to tax compliance. For auditors, it ensures efficiency, consistency, and professionalism. For taxpayers, it provides clarity, transparency, and the tools necessary to meet their obligations while protecting their rights. This dual focus ultimately strengthens the overall tax administration system in Malaysia.
Types of tax audit. A tax audit is an analysis of a taxpayer's financial affairs and business records to see whether the appropriate amount of income should be reported and the appropriate amount of tax should be computed and paid are in compliance with tax laws and regulations. The IRBM, which is the Inland Revenue Board of Malaysia, carries out two types of tax audit, which is General Review and Comprehensive Review. General Review is held at the IRBM's office and it concerns with straightforward issues. A taxpayer may be called for an interview at the IRBM's office if further information is required. It also checks information on income and expenses as well as various types of claims. Next is comprehensive review. Comprehensive review takes place at a taxpayer's premise where it involves the examination of taxpayers' business records and non-business records such as personal bank statements. A taxpayer will be given a prior notice to a field audit. Comprehensive review also typically covers general compliance audit and special audits. General compliance audit involves in checking expenses claimed, incentives, withholding tax, and other technical issues, while special audit covers in electronic trading, transfer pricing, or international client audit.
What are the objectives of tax audit? First, to encourage voluntary compliance with tax laws and regulations. Two, to encourage that a higher tax compliance rate is achieved under the self-assessment system. Three, to ensure the correct amount of income has been reported and the right amount of tax has been paid in accordance with the tax laws and regulations. Fourth, to educate and create awareness of taxpayers towards their rights and responsibilities. Now, let's understand more about the objectives of tax audit. The first one, to encourage voluntary compliance with tax laws and regulations, a tax audit serves as a mechanism to motivate taxpayers to adhere with tax laws. When taxpayers understand that audits are conducted regularly, it fosters a culture of compliance and deters non-compliance. It also helps ensure that individuals and businesses maintain proper records and follow prescribed tax guidelines. The second one is to ensure a higher tax compliance rate under the self-assessment system. Under a self-assessment system, taxpayers are responsible for calculating and paying their taxes. A tax audit ensures that taxpayers correctly follow these systems, enhancing the accuracy and reliability of tax declarations. This also minimizes the intentional or unintentional errors in tax filings. Lastly, is to educate and create awareness among taxpayers about their rights and responsibilities. Tax audit also serve an educational purpose by informing taxpayers about their obligations and entitlements under the tax laws. They provide an opportunity to clarify doubts, rectify misconceptions, and guide taxpayers on proper record keeping and compliance practices, thus improving overall tax literacy. These objectives collectively aim to promote transparency, fairness, and efficiency within the tax system while fostering trust between taxpayers and tax authorities.
Last but not least is year of assessment cover. Generally, the tax audit may cover a period of 1 to 3 years of assessment as determined in accordance with the tax audit focus criteria of the department, which are typically determined through risk assessment, pattern of tax filing, and the department priorities at any given time. There are two audit focus criteria. The first one is risk-based approach. Tax authorities may prioritize certain taxpayer or tax year for audit based on indicator of risk. They can include discrepancy in tax return, large fluctuation in income, or sufficient deduction and credit. The second one is compliance history. Taxpayer with a clean compliance record might only be subject to a limited audit period, such as the most recent is 1 until 3 years, whereas taxpayer with a history of non-compliance may face audit covering several years. However, the tax audit may be extended to cover a period up to 5 years of assessment pursuant to the issue and cover during an audit. Further, this 5-year time limit is not applicable to cases involving fraud and tax evasion, whether intentional or unintentional. There are two purposes of the extension. The first one is to ensure that systematic issue or pattern of non-compliance over a longer period are addressed. The second one is to recover unpaid tax, interest, and penalty for additional year. Last is implication of audit period. For taxpayers, they must maintain detailed and accurate record for at least 5 years to comply with audit. In fraud or evasion cases, longer retention of record is advisable. For tax authorities, they must ensure that significant tax liability are addressed regardless of what they accurate. Other than that, deterrence of fraud behavior by eliminating a time barrier of accountability. Thank you.